Good evening, everyone, and welcome to Economics at Midnight, where we'll walk through quiet explanations of how economic systems work. Tonight, we'll be looking at how money moves through the banking system. It's a topic that is mostly procedural, routine, and often overlooked, which makes it well suited for this time of night. Before getting settled, feel free to like the video if you find these explanations useful, and subscribe if this is something you'd enjoy returning to. Let me know in the comments where you're listening from and what time it is for you. It's always interesting to see how wide the listening window is at this hour. With that, the explanation will begin, and it will proceed slowly and without interruption. Money movement within the banking system serves as a fundamental part of modern economies. It begins with individuals or businesses depositing funds into their bank accounts. These accounts act as secure repositories for money, enabling account holders to store and manage their finances conveniently. When a deposit is made, bank records are updated to reflect the new balance. This process is handled through electronic ledgers, which contain detailed entries showing each transaction. These ledgers allow banks to maintain an accurate account of deposited funds, thereby ensuring clarity and transparency in financial records. Once the funds are securely deposited, account holders can initiate various transactions. One common form of transaction involves the transfer of money from one account to another. This process is often conducted via electronic funds transfer systems, which facilitate seamless and efficient movement of money. These systems connect financial institutions through secure networks, ensuring that transactions are safely processed and completed. The use of established electronic transfer methods helps in reducing potential errors and delays, thus maintaining confidence in the banking system's ability to handle funds accurately. In addition to electronic transfer systems, the process includes the clearing of checks. When a check is written, it represents a promise to pay a specified amount from the account balance. The recipient deposits the check into their own account, prompting the bank to verify availability of funds in the check writer's account. This verification is completed through a process known as clearing. In clearing, banks use a network to communicate and confirm the movement of funds. The bank of the check writer sends a request for payment to the bank where the check is deposited. Once approved, the transaction is completed and the relevant records are updated in both banks' ledgers. After funds are cleared and transferred, reconciliation occurs. Reconciliation involves verifying that all transactions are accurately recorded and that account balances match across different records. It ensures the integrity of the financial system by resolving discrepancies that might arise from various transactions. Banks perform reconciliation routinely, comparing internal records with statements from other financial institutions. This process helps banks maintain accurate and reliable records, building trust among account holders and other stakeholders. The consistent movement of money relies heavily on a network of payment systems. These systems facilitate various types of transactions, including debit and credit card payments. When a card payment is made, the transaction is processed by a payment system, which communicates with the issuing bank to verify the availability of funds and authorize the payment. Payment systems operate continuously, enabling countless transactions to occur simultaneously without interruption. This regular operation ensures that money can move through the banking system efficiently, supporting the daily economic activities of individuals and businesses alike. Central to the functioning of payment systems is the role of clearinghouses. Clearinghouses act as intermediaries between banks, specifically handling the exchange of payment instructions. They compile and sort transaction data, facilitating the settlement process by determining the net position of each bank involved. Settlement involves the actual exchange of funds, which is completed according to the net amounts calculated by the clearinghouse. By acting as a hub for these transactions, clearinghouses help streamline the movement of money, ensuring efficiency and reducing the likelihood of errors. An important aspect of this entire process is the role of central banks. Central banks oversee and regulate the banking system, setting rules and providing oversight to ensure stability and reliability. They manage the supply of money in the economy, influencing interest rates and monetary policy to maintain economic balance. Central banks also serve as a source of liquidity for commercial banks, allowing them to manage their reserves effectively. Through these roles, central banks maintain confidence in the banking system, supporting its smooth operation. Money movement in the banking system is also supported by interbank markets, where banks lend and borrow money from one another. These markets enable banks to manage their liquidity, ensuring they have sufficient funds to meet their daily operational needs. When a bank faces a shortfall, it can access the interbank market to borrow the necessary funds. Conversely, banks with excess reserves can lend to others, earning interest in return. The regular functioning of interbank markets contributes to the fluidity of money within the banking system, aiding in the efficient distribution of funds. Moreover, technological advancements have further enhanced the efficiency of money movement. Digital banking platforms offer account holders access to their finances via online portals and mobile applications. These platforms enable users to perform transactions conveniently from remote locations, increasing the flexibility and accessibility of banking services. By providing real-time access to account information and transaction capabilities, digital banking solutions support the seamless flow of money, aligning with the needs of a modern, connected world. Throughout the banking system, security measures are in place to protect the integrity of financial transactions. Encryption and authentication protocols are utilized to safeguard data, preventing unauthorized access and ensuring transactional legitimacy. These security practices are an essential part of maintaining trust within the banking system and allowing money to move freely. They help prevent fraud and theft, providing account holders with confidence that their funds are well protected. It is also important to understand how banks profit from facilitating the movement of money. Banks charge fees for various transaction services, such as account maintenance and foreign exchange. Additionally, they earn interest from loans and investments made using deposited funds. These revenue streams enable banks to cover operational costs and invest in improvements, supporting the continued efficiency of the banking system. The movement of money through the banking system is thus an intricate yet routinely managed process. It involves various interconnected components, each playing a specific role in ensuring money flows smoothly and securely. Through repeated established practices, the system supports economic stability and enables the daily financial transactions that occur within society. This ongoing process of money movement remains a cornerstone of modern financial systems. In the realm of banking, the process through which money moves involves a series of routine interactions between various financial institutions. One initial element in this movement is the clearing process. Clearing refers to the series of steps taken to reconcile and validate transactions before they are settled. When a person deposits a check, for example, the banks involved need to communicate and verify the details of the transaction. This communication is part of what makes up the clearing process, and it helps ensure that funds are appropriately moved from one account to another. Clearing systems are designed to process these exchanges efficiently and replicate them daily. Next in the process is settlement. Settlement occurs after clearing and involves the actual transfer of money between banks. During settlement, the banks finalize the transaction by debiting and crediting the respective accounts. This transfer can occur in various forms, such as electronic funds transfers or traditional paper-based transactions. Settlement systems are usually managed by central or national banks and play a significant role in maintaining the stability of the financial system. These systems are engineered to handle large volumes, ensuring that the movement of money continues smoothly and without disruption. Within each bank, transactions are recorded in ledgers. Ledgers are essentially detailed records that track all financial transactions. They provide a comprehensive view of debits and credits, ensuring that all money movements are accurately captured and stored. This meticulous record-keeping allows banks to manage account balances efficiently and provide accurate statements to customers. These ledgers form part of the core operational structure of banking institutions, supporting their internal accounting and reporting functions. They are updated frequently, reflecting every change as funds flow in and out. Balances within accounts are another key concept in the movement of money. A balance represents the amount of available funds in a specific account at any given time. It is constantly updated to reflect completed transactions, deposits, and withdrawals. Account holders rely on these balances to manage their finances, while banks depend on them to maintain the integrity of their records. Balances are part of everyday banking operations, facilitating the management of customer funds and enabling smooth financial interactions. They are essential in ensuring that both individuals and institutions can track their financial positions accurately. One more essential element in the flow of money is the process of reconciliation. Reconciliation is the method by which banks ensure that their internal records align with external accounts and statements. This process requires comparing records from different sources, identifying discrepancies, and making necessary adjustments. It is a routine part of banking operations and is critical in maintaining the accuracy and integrity of financial records. Regular reconciliation helps institutions detect and rectify errors promptly, fostering trust and reliability in banking practices. This ongoing adjustment process forms part of the fabric of institutional banking. Each of these processes relies on a network of communication systems that link different banking institutions together. These systems enable the exchange of information, supporting the clearing, settlement, and reconciliation of transactions. Communication systems are structured to provide secure and swift data transfer. They connect local banks to national and international counterparts, ensuring the seamless flow of money across various regions and jurisdictions. These networks are continuously monitored to maintain operational efficiency and security, playing a crucial role in the overall function of the banking system. The role of central banks in the movement of money is also significant. Central banks often act as intermediaries in the clearing and settlement process. They provide clearinghouses, which serve as central points for processing transactions between commercial banks. By doing so, central banks facilitate the efficient exchange and settlement of funds. They also offer services that support the stability of the monetary system, such as managing national payment systems and providing liquidity support to banks. The activities of central banks are designed to ensure smooth financial operations, underpinning the movement of money in the broader economy. Another component in the money movement process is the role of correspondent banks. Correspondent banks provide services on behalf of other banks, especially in international transactions. They facilitate transactions across borders by functioning as an intermediary, enabling banks to conduct business without needing a presence in the foreign market. This arrangement helps in streamlining processes and reducing transaction costs. Correspondent banking relationships are part of the everyday operations in global finance, allowing money to move between different currencies and legal systems seamlessly. The infrastructure supporting these processes is made up of various technological systems. Banks utilize information technology to manage their operations, including the movement of money. These systems handle transaction processing, record keeping, and communication, essential for facilitating day-to-day banking activities. Information technology systems in banks are designed to offer reliability and security, ensuring that all operations are carried out efficiently. These systems are regularly updated and maintained to adapt to evolving needs and regulatory requirements. Standard operating procedures within banks play a vital role in ensuring the consistent movement of money. These procedures establish the guidelines that employees follow to process transactions, manage accounts, and maintain records. Standard operating procedures contribute to operational efficiency and compliance with legal and regulatory requirements. They ensure that money moves through the banking system in an orderly and predictable manner. Such procedures are integral to maintaining the smooth functioning of banking institutions and are regularly reviewed and updated as necessary. Banks also employ various control mechanisms to safeguard the movement of money. These controls encompass a range of policies and procedures designed to prevent fraud, errors, and other risks. Controls are integrated into different stages of the money movement process, from transaction authorization to record verification. By employing these controls, banks aim to preserve the integrity and security of financial operations. They are fundamental to the trusted nature of the banking system, providing assurance to customers and stakeholders alike. The regulatory framework within which banks operate is another aspect influencing the movement of money. Regulations govern various aspects of banking operations, including how money is transferred, recorded, and reported. These regulations are established by government bodies and financial authorities to ensure the stability and transparency of the financial system. Compliance with regulatory requirements is an ongoing obligation for banks, influencing their procedures and policies in the movement of money. The regulatory environment is a fundamental part of banking, providing the legal structure for consistent and reliable financial operations. Money moves through the banking system in a series of established and routine steps. When an individual deposits money into their bank account, the process begins. This deposit is recorded in the bank's ledger, marking an increase in the account holder's balance. The ledger serves as a persistent record, ensuring accuracy and transparency. The funds are then available for various transactions, including withdrawals, transfers, or payments. Through these processes, the money starts its journey through the broader banking system. When a customer decides to transfer money to another account, the banking system facilitates this movement seamlessly. The process starts with the account holder instructing the bank to transfer a specified amount. This instruction can be given through various means, such as online banking or visiting a branch. Once the instruction is received, the bank updates its records to reflect the movement of funds. This update is crucial as it maintains the precise state of the account holder's balance. The bank then initiates the transfer, often using systems like the automated clearinghouse (ACH) or wire transfers. The automated clearinghouse is a network that facilitates the movement of funds between banks. It processes large volumes of transactions in batches, providing a reliable means of transferring money. ACH transactions are common for various payments, such as direct deposits or recurring bills. These transactions are typically executed in a predictable time frame, often taking a few business days. The ACH system prioritizes reliability and efficiency, ensuring that funds reach their destination as expected. Wire transfers, on the other hand, provide a faster method for moving money. They are often used for larger sums or when speed is essential. A wire transfer involves direct communication between two banks, usually facilitated by systems like SWIFT. Unlike ACH, wire transfers are processed individually, allowing for quicker completion. This method incurs higher costs due to its speed and direct nature. Each step is monitored to provide security and verification. Once the money has reached the receiving bank, it is recorded in their ledger, reflecting an increase in the recipient's balance. The accurate updating of these records is vital for maintaining trust and operational fluidity within the banking system. The systems and processes involved ensure that funds are allocated correctly and efficiently. This ensures the effective functioning of the bank's internal mechanisms and overall trust in the system. Banks also engage in internal reconciliation processes to maintain accuracy. Reconciliation involves comparing different sets of records to ensure consistency. It helps identify discrepancies that may arise from errors or delays in processing. Through routine reconciliation, banks verify that all transactions align with recorded data. This verification process is a standard practice, safeguarding the integrity of the banking system. Clearing is another crucial aspect when money moves between banks. Clearing refers to the process of confirming and approving transactions before they are settled. It ensures that all requirements are met and that there are no issues with the transaction. This step is necessary to mitigate risks related to insufficient funds or incorrect account details. Clearing provides a layer of security before the final settlement occurs. Settlement represents the final phase in the movement of money through the banking system. During settlement, the actual transfer of funds between banks takes place. This phase results in the official debiting and crediting of accounts involved in the transaction. Settlement aims to finalize the transfer and ensure that all parties have updated balances. It confirms the completion of the transaction process within the banking network. The role of central banks is also notable in the movement of money. Central banks provide oversight and ensure stability within the banking system. They set regulations and guidelines that banks must follow to maintain operational soundness. Central banks may also facilitate transactions involving different currencies, providing exchange services. They play an essential role in supporting the broader financial infrastructure. Throughout these processes, technology acts as a crucial enabler. Banks use sophisticated systems to manage transactions and keep records accurately. These systems allow for efficiency and accuracy, reducing the risk of errors. Digital interfaces provide customers with real-time access to their accounts, enhancing transparency. Technology thus supports the seamless movement of money and strengthens customer confidence. Each bank within the system interacts with others to facilitate the transfer of money. This interaction creates a vast, interconnected network. Banks communicate frequently to finalize transactions and verify information. The cooperation ensures that the movement of funds is smooth and uninterrupted. It embodies the collective functioning of the wider financial ecosystem. Compliance with regulations is vital throughout the entire process. Banks must adhere to legal requirements governing transactions and record keeping. These regulations ensure the security of both the banks and their customers. By complying, banks foster trust and stability in the economy. Regulatory adherence is a continuous and integral aspect of money movement. Routine audits are performed to review processes and systems. Audits help maintain transparency and uncover areas for improvement. They assess how well banks adhere to established rules and standards. This routine aspect reinforces operational soundness and public trust. Audits contribute to maintaining system integrity and reliability. Customer data privacy is respected and protected in every transaction. Banks use encryption and other security measures to safeguard information. Privacy protocols ensure that data is kept confidential and secure. This aspect reassures customers that their information is safe. Security remains a priority in the movement of money. Banks also engage in risk management as funds move through the system. Risk management involves identifying potential issues that could impact transactions. It ensures that measures are in place to address any challenges that may arise. By managing risks, banks protect their operations and clients' interests. This ongoing attention to detail supports system resilience. The seamless movement of money is a testament to established banking processes. These processes operate consistently and predictably. They serve to maintain the trustworthiness and functionality of the banking network. The systems in place continue to ensure that money moves efficiently. In the banking system, the movement of money is a routine process managed through a variety of established mechanisms. One crucial component of this system is the payment order. Payment orders are instructions given by a payer to their bank requesting the transfer of money to a payee's account. These orders can be issued in many forms, such as checks, electronic fund transfers, or wire transfers. Each form possesses its own set of standardized procedures designed to ensure accuracy and security. This routine facilitates the smooth execution of transfers, allowing funds to move seamlessly between accounts held at different financial institutions. Once a payment order is initiated, the bank receiving the instruction must verify the details. Verification involves checking for sufficient funds in the payer's account and authenticating the user's identity. These steps are crucial to prevent errors and unauthorized transactions. Verification usually employs standardized protocols, including password checks, security questions, or more advanced biometric methods. This careful examination ensures that only legitimate transactions are processed, maintaining the integrity of the banking system. The process of verification is repeated consistently with each transaction, reinforcing trust between financial institutions and their clients. After authentication, the bank debits the payer's account, decreasing the balance by the specified amount. This process is recorded in the bank's ledger, a comprehensive and detailed record of all transactions. The ledger reflects every financial activity, ensuring that records are precise and transparent. The maintenance of these ledgers is a routine part of banking operations, involving meticulous documentation of each debit and credit. The accuracy of these records is vital as they form the backbone of financial reporting and analysis. Banks commit significant resources to maintaining these records, employing specialized software and trained personnel to keep ledgers updated. Once the funds are debited, the bank initiates the interbank transfer process. This transition typically involves routing through a centralized clearinghouse or automated system which manages the flow of funds between different banks. The clearinghouse acts as an intermediary, reconciling and settling transactions in batches. This centralized system allows banks to process high volumes of transactions efficiently while reducing the risk of individual errors. The clearinghouse ensures that each transaction is matched with the corresponding entry from another bank, effectively settling the interbank obligations. This step is one of the essential components of the established banking network. Simultaneously, the payee's bank is notified of the incoming funds. This notification triggers a series of internal processes within the receiving bank. First, the bank verifies the details of the transaction to ensure it aligns with the bank's records and does not conflict with any internal policies. Once verification is complete, the bank credits the payee's account, increasing its balance. This step finalizes the payment order, reflecting the successful movement of money from one account to another. Each bank carries out these procedures consistently, following standardized protocols that support the reliability and predictability of the banking system. In the context of international transactions, the process involves additional layers. Cross-border payments require the coordination of multiple financial institutions, often involving currency conversion. When sending money internationally, banks utilize correspondent banking relationships, agreements that enable different banks across countries to conduct transactions on behalf of each other. The correspondent bank network provides an established framework for conducting cross-border payments. These relationships are built on mutual trust and standardized practices, ensuring that international transfers are secure and appropriately settled. The role of correspondent banks is especially significant in facilitating global trade and remittances. Currency conversion is another critical aspect of international money movement. When funds are transferred between countries, the currency in which the payment is made must often be converted into the recipient's currency. This conversion is facilitated by foreign exchange markets, where banks negotiate exchange rates and execute currency trades. The foreign exchange process is generally automated, ensuring timely and accurate fulfillment of exchange operations. Once the currency is converted, the funds proceed through the international clearing system, allowing them to reach the payee's bank. These routine processes enable diverse economic activities between nations, supporting global financial interactions. Within the banking system, the role of regulatory frameworks is significant. Regulatory bodies establish guidelines and standards that govern how banks operate and manage transactions. These regulations are designed to ensure the safety, soundness, and efficiency of financial operations. Compliance with such regulations is a routine responsibility for banks, involving regular reporting and audits. Regulators may prescribe specific requirements for handling money transfers, fraud prevention measures, and customer protection protocols. The established framework aims to protect consumers and maintain financial stability, creating a secure environment for various banking activities. Banks also employ reconciliation processes to ensure that the movement of money aligns with bank records. Reconciliation involves cross-checking and validating transaction data, ensuring the accuracy and completeness of records. This routine audit helps identify discrepancies, allowing banks to address them promptly. Reconciliation is often conducted daily, involving the use of specialized software that compares internal records with those of external entities. The process is crucial for maintaining trust and transparency within the banking system, as it confirms that all transactions are accounted for correctly. Through this repeated activity, banks assure stakeholders of the reliability of their financial commitments. In some cases, the movement of money involves additional checks, such as anti-fraud measures. Banks employ various tools to monitor transactions for suspicious activity, implementing protocols to detect and prevent fraudulent behavior. These measures may include pattern recognition, where algorithms analyze transaction data for anomalies. Suspicious transactions trigger alerts for further investigation, ensuring that potential risks are addressed promptly. This routine vigilance helps safeguard customer assets and the integrity of the banking system, contributing to a trusted financial environment. The routine functioning of the banking system is supported by ongoing technological advancements. Technology plays a significant role in automating many functions, increasing efficiency and reducing manual errors. The use of digital platforms has streamlined processes such as payment orders, clearing, and reconciliation. Software solutions enable banks to manage vast amounts of transaction data effectively, ensuring that operations are both swift and reliable. The integration of technology continues to evolve, offering new capabilities and enhancing existing procedures. These advancements reflect the banking sector's commitment to maintaining a robust and responsive system for clients. The movement of money through the banking system is a continuous process, sustained by an infrastructure of rules, technologies, and practices. When considering how money moves through the banking system, the role of the central bank becomes an essential aspect. Central banks serve as the backbone of national financial systems, overseeing monetary policy and regulating commercial banks. In this segment, we will focus on the connection between central banks and commercial banks. The central bank manages the supply of money and ensures liquidity within the financial system, setting the stage for smooth interbank transactions. It acts as the lender of last resort for commercial banks, providing necessary funds during times of financial strain. Commercial banks are required to hold reserves with the central bank. These reserves act as a safety net and are a fraction of the bank's deposits. This reserve requirement ensures that banks can meet withdrawal demands from their customers. The central bank achieves control over the money supply and interest rates through these reserves. By adjusting reserve requirements, it influences the amount of money banks can lend. This regulation ensures stability in the banking system and helps prevent excessive inflation. Interbank lending is another important mechanism facilitated by the central bank. Banks often need short-term loans to balance their daily operations and meet their reserve requirements. The interbank lending market allows banks to lend excess reserves to one another. This borrowing typically happens overnight and is facilitated at interest rates often influenced by the central bank's policies. The central bank's interest rate, often known as the policy rate, serves as a benchmark for these transactions. Payment systems are the infrastructural backbone of money movement within the financial system. Central banks often oversee these systems, ensuring that transactions are secure and efficient. Various payment systems exist, handling different types of transactions. Real-time gross settlement systems, RTGS, provide immediate settlement of high-value transactions, transferring funds individually. These systems ensure that large volumes of money can move swiftly between banks, minimizing systemic risk. On the other hand, automated clearinghouses, ACH, manage bulk transactions, such as payroll or utility payments. ACH systems process these transactions in batches, typically at scheduled times. This process is slower compared to RTGS, but it is efficient for handling large numbers of smaller transactions. Both systems are integral to ensuring that money transfers occur smoothly and reliably across the financial system. Central banks also play a vital role in the stability and security of these payment systems. They set operational standards and monitor compliance to prevent fraud and cyber threats. By maintaining oversight, central banks ensure that confidence in these systems remains high among banks and their customers. This trust is essential for the seamless flow of money throughout the financial system. Clearing and settlement processes are crucial components of the financial system. Clearing involves the exchange of transaction information between banks. It determines the obligations each bank has to others. Settlement, on the other hand, involves the actual transfer of funds to fulfill these obligations. Central banks often facilitate these processes to ensure accuracy and efficiency. By overseeing settlement systems, they help maintain a stable and secure financial environment. The process of reconciliation follows clearing and settlement. Banks must ensure that their internal records align with transaction statements received from other banks. This routine process identifies any discrepancies and rectifies them promptly. Effective reconciliation minimizes errors and reduces the risk of financial losses. It also ensures that banks maintain accurate records of their financial transactions. In addition to real-time transactions, daily settlements form the basis of most banking operations. Banks process a multitude of transactions each day, requiring efficient systems to settle them. Daily settlements involve accumulating transactions and resolving obligations at specific intervals. This routine ensures that all parties receive the funds they are entitled to in a timely manner. The concept of correspondent banking is another mechanism in the movement of money. Banks often form relationships with correspondent banks in other regions or countries, providing services they may not have locally. These relationships enable banks to access foreign markets or facilitate international trade. Through correspondent banking, banks can offer a wider range of services to their customers and extend their reach beyond domestic boundaries. The process of money movement in the banking system often involves multiple currencies. Foreign exchange markets play a key role in facilitating these transactions. Banks participate in the foreign exchange market to convert currencies, ensuring that international transactions can occur smoothly. Central banks may also intervene in foreign exchange markets to stabilize currency values, further impacting the movement of money. Interest rate adjustments by central banks provide another mechanism through which money moves. By raising or lowering interest rates, central banks influence borrowing and lending behaviors across the financial system. Lower interest rates typically encourage borrowing and spending, while higher rates may discourage these activities. Through these adjustments, central banks influence overall economic activity and money flow. Lending and borrowing transactions form the basis of commercial banks' operations. Banks provide loans to businesses and consumers, promoting economic activity and growth. These loans are funded by deposits from customers, illustrating the model of money circulation within the system. Depositors earn interest on their savings, while borrowers pay interest on loans, generating profit for the bank. This cycle of lending and borrowing is foundational in the banking system. Collateral management is an important aspect of lending. Banks often require borrowers to provide collateral, securing loans against potential defaults. By managing collateral, banks protect themselves from credit risk and ensure that they can recover funds if a borrower fails to repay. This practice contributes to the stability of the banking system, ensuring prudent lending. Money creation is another process associated with the movement of funds through banks. When banks extend loans, they effectively create new money. The process involves crediting the borrower's account with the loan amount, which increases the overall money supply. This fractional reserve banking practice allows banks to lend more than what they physically hold in reserves. The careful regulation of money creation is vital to prevent excessive inflation. Central banks monitor lending activities and adjust policy as necessary. By controlling reserve requirements and interest rates, they ensure a balanced money supply. This careful balance supports economic stability and growth. The movement of money through the banking system is intricate, yet it unfolds through routine and procedural steps. Money travels through the banking system via a series of established and repeated processes. These processes can be observed as they facilitate the smooth and consistent movement of funds from one point to another. An essential part of these processes involves deposit accounts, which individuals and entities use to store their funds in banks. Depositing money into an account initiates a record on the bank's ledger, reflecting the amount credited. This ledger serves as a reliable record-keeping system, ensuring that the bank accurately tracks each transaction against customer accounts. Once funds are deposited, banks frequently transfer these funds across different accounts, both internally within the same bank and externally between different banking institutions. Such transfers make use of payment systems designed to facilitate interbank settlements. Payment systems operate through networks that allow banks to communicate and execute transactions efficiently. These networks reduce the need for physical movement of cash by employing electronic methods, which are both secure and efficient. Within this framework, money moves from one account to another based upon predetermined instructions provided by the account holders. Banks use clearinghouses as a critical part of the interbank transaction process. A clearinghouse acts as an intermediary, coordinating the settlement of transactions between different banks. When one bank needs to transfer funds to another, it may route the transaction through a clearinghouse. The clearinghouse then assumes the role of ensuring that both parties in the transaction fulfill their obligations before funds are moved. This service helps to mitigate the risks involved with direct bank-to-bank transactions, providing a layer of security and trust. The settlement process itself is where final payment occurs between banks. During settlement, the instructed funds are moved from the sender's bank to the recipient's bank, completing the transaction. Settlement might occur in real time, or it could be executed at designated intervals throughout the day, depending on the payment system in use. Some systems operate continuously, while others gather transactions for batch processing during specific windows. This methodical approach ensures that all parties involved have the opportunity to verify the accuracy of transactions and manage liquidity efficiently. A vital component in the movement of money is the central bank, which plays a pivotal role in overseeing and facilitating the interbank settlement process. The central bank may hold reserve accounts for commercial banks through which settlements are executed. Reserve accounts function as a form of safekeeping for banks, ensuring they have the necessary resources to fulfill their transaction commitments. Central banks also often provide liquidity support, should banks require additional funds to complete their settlements. This system maintains stability and confidence across the banking system, ensuring operations proceed without interruption. In addition to transactions between banks, the movement of money also involves customer-led transactions, such as direct debits and credits. Direct debits enable an account holder to authorize another entity to withdraw funds from their account, typically for recurring payments. Conversely, direct credits allow funds to be sent to someone else's account, as seen with payroll deposits or government benefits. These transactions are typically governed by standardized protocols that ensure consistency and reliability, maintaining the integrity of fund transfers across different banking platforms. The role of automated clearing systems should not be overlooked in this routine. Automated clearinghouses, ACH, handle bulk transactions, accepting and processing instructions in batches. These systems are particularly suited for handling numerous transactions simultaneously, such as salary payments or utility bills. ACH services streamline the process by converting electronic payment instructions into settlement transactions efficiently. This automated system minimizes manual intervention and reduces processing errors, making large-scale fund transfers straightforward and predictable. Another critical aspect of money movement within the banking system is reconciliation. Reconciliation involves comparing transaction records held by a bank with those of other parties involved in transactions to ensure consistency. This process ensures that all entries recorded within the bank's ledgers match corresponding records held by the counterparty. Any discrepancies are examined and resolved before settlement occurs, preventing potential disruptions in the transaction flow. Reconciliation represents a crucial control measure within the banking framework, supporting the accuracy and reliability of the money movement. Credit card transactions provide another avenue through which money moves across the banking sector. When a customer uses a credit card to make a purchase, the transaction begins with the merchant's bank communicating with the customer's card issuer. If authorized, the issuer agrees to provide the required funds to the merchant, creating an obligation for the cardholder to repay the issuer. This network of communication between cardholders, merchants, and banks relies on secure processing services that authenticate and facilitate payments efficiently. The banking system also employs electronic funds transfer (EFT) technology to expedite the movement of money. EFT allows for the electronic transfer of funds between accounts, bypassing the need for paper-based instruments like checks. This method promotes faster and more reliable transactions, suitable for both personal and commercial banking needs. EFT can be used for a variety of functions, including paying vendors, transferring salaries, or even handling cross-border payments. The flexibility and speed of EFT have made it a preferred mode of operation within the contemporary banking environment. Checking accounts offer a familiar, everyday perspective on money movement. Individuals use checking accounts to write checks, initiate debit transactions, or execute bank transfers. Each of these activities results in a transfer of funds from the account holder to a designated recipient. Checking accounts often serve as the primary conduit for managing personal finance transactions, providing a clear snapshot of an individual's spending activities. The bank acts as the intermediary, managing the debits and credits associated with these transactions. In each of these processes and systems, the banking infrastructure consistently relies on well-defined sets of protocols to ensure stability and order. These protocols, refined over time, enable the seamless movement of funds, supporting both personal and commercial needs within the economy. By adhering to these standards, banks fulfill their roles effectively and maintain trust with their customers. While the processes involved can differ, the principles guiding the movement of money remain rooted in stability and predictability. A fundamental aspect of money movement in the banking system is the process of electronic funds transfers, often abbreviated as EFTs. These are mechanisms that allow money to be transferred electronically between different bank accounts. Banks utilize a network of computerized systems to facilitate these transfers. These systems identify the sender and receiver accounts, execute the transfer, and update the respective account balances accordingly. Routine checks ensure that the transferred funds are available in the sender's account before the transfer proceeds. This process is highly regulated to maintain accuracy and reliability. Another integral process is the automatic clearinghouse, commonly referred to as ACH. The ACH system facilitates the batch processing of numerous transactions. Unlike individual electronic transfers, ACH transactions are collected and processed in bulk. This method tends to be used for payroll deposits, utility payments, and other recurring transactions. The transactions accumulate throughout the day and are processed at designated times, often overnight. The ACH network provides a framework that ensures consistent processing times and reliability. It allows financial institutions to handle transactions efficiently and securely. Within the banking landscape, the central role of clearinghouses emerges as a critical component in the transfer process. These entities act as intermediaries, helping streamline and validate the transactions between banks before completion. A clearinghouse receives transaction details from sending and receiving banks and performs necessary checks. Once verified, the clearinghouse will communicate the clearance, allowing the final settlement of funds. This system helps mitigate risks and ensures consistency in the transfer process. Over time, it has become an indispensable piece of financial infrastructure. Settlement is the phase following the clearing process. It involves the actual movement of funds between banks. Once a transaction clears, the banks involved update their ledgers to reflect the transfer's completion. Settlement systems ensure that funds are accurately moved and recorded in each institution's accounts. Prompt settlement is crucial because it confirms the completion of a transaction. By the end of the settlement process, both the sending and receiving banks have reconciled the transfer. This seamless reconciliation supports trust in the financial system. In the context of international transactions, a key process known as correspondent banking comes into play. This system allows banks in different countries to facilitate cross-border transactions. Correspondent banks help domestic banks access banking services in foreign countries. These banks hold accounts with one another. They use these accounts to execute transactions on behalf of their respective clients. The accounts, called Nostro and Vostro accounts, keep track of these financial activities. This arrangement ensures that international transactions can proceed smoothly. A vital component of the banking system is the continuous process of reconciliation. Reconciliation involves the routine balancing of accounts to mirror transactional activities. Banks regularly match their internal ledgers with external financial statements. This ongoing process helps ensure that any discrepancies are identified and corrected promptly. It prevents errors and supports knowledge of the institution's financial status. Reconciliation is a consistent, necessary activity that fortifies the accuracy of bank records. Through careful attention to this process, banking institutions uphold the integrity of their operations. The practice of maintaining ledgers is another essential part of banking operations. Ledgers are detailed records of all transactions conducted by a bank. These documents play a crucial role in tracking the movement of money. Each entry in a ledger records key details such as transaction date, amount, and parties involved. By keeping accurate ledgers, banks can verify and audit their financial activities. Ledgers serve as a historical record that supports transparency and accountability. Banks use these records to ensure that all transactions are conducted within regulatory and operational guidelines. Interbank transfers form another layer of complexity within money movement. These transfers occur when one bank sends money to another bank. The process may involve direct relationships between the banks or utilize a network of correspondent banks. The funds transfer requires precise coordination between institutions to finalize. Upon receiving the funds, the destination bank credits the amount to the appropriate account. This process reflects the established systems banks have developed to manage these transactions seamlessly. They rely on communication and trust among institutions. The infrastructure supporting real-time gross settlement, abbreviated as RTGS, is crucial. This system allows for the immediate transfer of funds between banks on an individual transaction basis. Unlike batch processing systems like ACH, RTGS settles transactions one at a time throughout the day. This process ensures that funds are readily available to the recipient immediately upon transfer. RTGS provides an efficient method for banks to manage large value transactions. The system's promptness enhances liquidity within the financial system. Time holds a significant aspect within the operations of the financial systems. The handling of transactions within specified windows, known as end-of-day processing, is significant. At the end of the banking day, institutions review and finalize the day's transactions. This routine ensures that all activities conducted throughout the day are accurately recorded and balanced. The end-of-day processing routine helps banks prepare for the next business day by closing any outstanding activities. It serves as a structured approach that upholds operational continuity. A routine aspect of financial transactions is fee assessment, where banks may levy charges for specific activities. These fees can relate to services such as wire transfers, overdrafts, or account maintenance. Fee structures are clearly defined and communicated to customers. Banks regularly review and adjust these fees to reflect operational costs and regulatory guidance. Understanding fee schedules assists both banks and their clients in anticipating costs associated with financial activities. This transparency supports informed decision-making. Within these systems, the concept of liquidity management plays a central role for banks. Liquidity management involves ensuring sufficient funds are available to meet daily obligations. Banks maintain a balance between incoming and outgoing cash flows to manage liquidity. Strategic planning assists banks in preparing for fluctuating demands on funds. By analyzing cash flow trends, banks maintain the capacity to address daily cash requirements. This process is vital for sustaining the ongoing operations of the institution. One final aspect encompasses the necessity of regulatory compliance in the banking system. Authorities set forth guidelines and regulations that banks must follow to operate legally. Compliance with these regulations ensures fair practices and protects consumers. Banks allocate resources to ensure their systems are aligned with compliance requirements. Regular audits and reviews help banks stay informed and adapt to changes in regulatory landscapes. This structured approach ensures a stable environment within which financial institutions can operate effectively. Money movement within the banking system follows a structured and established process. Every transaction begins when an individual or an institution initiates a transfer, which could be as simple as paying a bill or as detailed as interbank transfers. The initial step involves entering the transaction details into a digital platform, whether at a bank branch, through an online banking portal, or via a mobile application. This step records the intent to transfer money and sets the transaction process in motion. Subsequently, the transaction data is entered into the bank's internal system. Within this system, a series of routine checks are conducted to ensure validity and sufficiency. The bank verifies that the sender's account has sufficient funds available to cover the transaction. This verification is crucial in ensuring that no account is overdrawn without prior arrangement. The system performs these checks automatically, utilizing the bank's internal software, a familiar and routine procedure that repeats for each transaction. After verification, the transaction enters the clearing stage. Clearing involves the determination of how the transaction will settle. This step includes identifying the appropriate route and mode for transferring funds, depending on the relationship between the sending and receiving banks. If both accounts belong to the same bank, the transfer occurs internally. However, if different banks are involved, further procedures are necessary. For transactions between different banks, interbank systems such as automated clearinghouses, ACH, or real-time gross settlement, RTGS, systems are used. ACH transactions typically involve batch processing, enabling numerous transactions to be grouped and processed collectively at scheduled intervals. This method is efficient and widely used for payments such as payroll deposits and utility payments, providing a cost-effective means to transfer funds. Alternatively, the RTGS system processes transactions individually and in real time. This method is usually reserved for high-value transfers requiring immediate settlement. Though more resource-intensive than batch processing, it ensures that funds transfer without delay, minimizing any associated risks. The decision between these systems depends on the transaction's urgency and priority. Once the appropriate path is chosen, the transaction progresses to the settlement phase. Settlement is the actual transfer of funds from the sender's bank to the receiver's bank. At this stage, central bank accounts often come into play, particularly for transactions across banks. If banks maintain accounts with the same central bank, funds are transferred directly between these accounts. This ensures that both banks accurately reflect the transferred amounts. In transactions where different central banks are involved, they act as intermediaries. These banks move the funds using their established policies and procedures, ensuring a smooth transaction. The efficiency of this process depends on the cooperation and coordination between the involved financial institutions. These procedures are thoroughly standardized to maintain consistency and reliability across countless transactions daily. After settlement, reconciliation takes place. During this stage, each institution involved ensures that their records match the actual transactions. This involves comparing the internal records against the central bank statements of account movement. Requisition of corrections from any discrepancies is routine. Such scrutiny ensures accuracy and accountability, reinforcing trust in the banking system. Banks also provide their customers with updated information on their accounts post-transaction. Account holders receive notifications confirming the transaction's completion. These notifications ensure transparency, allowing individuals and institutions to verify their own records. This final step closes the transaction loop, providing clarity and assurance. The entire money movement process serves to facilitate numerous daily economic activities. While steps are automated, oversight by banking professionals ensures compliance with regulations and standards. This professional engagement enhances security and reliability. Through consistent execution of these processes, the banking system maintains an orderly flow, supporting both individual and corporate needs. Systems in place for handling money movement are often designed to adapt to evolving technologies. As advancements occur, banks integrate these technologies into their operations to enhance process efficiency and capacity. Over time, these innovations allow for faster processing times and increased transaction volumes, reflecting the dynamic nature of the financial system. Despite technological integration, the core elements of money movement processes remain unchanged. The fundamental procedures continue to be driven by verification, clearing, settlement, and reconciliation. This stability within the processes is essential, ensuring that all participants maintain a common understanding of how funds move. Consequently, errors are minimized, enhancing overall system reliability. Understanding how money moves through the banking system provides insight into broader economic functions. Each transaction may seem simple, yet it relies upon well-orchestrated processes involving various actors and technologies. The effective movement of money underpins numerous economic activities influencing diverse sectors. In conclusion, each step reflects a routine process with countless transactions daily. Even with advancements, the underlying principles ensure that money movement is consistent and secure. Money movement through the banking system involves several structured stages. Initially, money is deposited in a bank account. This account could belong to an individual, a business, or another institution. When money is deposited, it is recorded electronically. The bank updates its ledger to reflect the addition of these funds. The ledger, in essence, is an electronic book of transactions. It serves as a comprehensive record detailing deposits, withdrawals, and transfers. Each entry must balance according to established accounting principles. The goal is to maintain accurate records of all financial activities. Once the funds are deposited, they can be transferred to another account within the same bank. This is an internal transfer. The bank simply adjusts the balances in its own ledger. The sender's balance decreases, while the recipient's increases by the same amount. These transfers happen quickly because they do not leave the confines of the single banking institution. This ability to make swift internal adjustments is a hallmark of modern banking systems. It provides convenience to account holders who manage multiple accounts. For transactions involving different banks, the process becomes slightly more complex. Here, the interbank transfer system is used. This system ensures money moves from an account in one bank to an account in another. One common method for this transfer is the automated clearinghouse, often referred to as ACH. The ACH system processes transactions in batches. This means many transactions are pooled together and processed at scheduled times. As a result, ACH payments might take a day or two to complete. An alternative to the ACH system is the use of wire transfers. Wire transfers are direct and often quicker than ACH. They involve real-time settlement, meaning funds are transferred as soon as the transaction is initiated. However, wire transfers typically come with higher fees. Despite this cost, they are favored for urgent or large-sum transactions. The process involves secure networks used by financial institutions to settle payments. These networks, such as SWIFT, establish connections between different banks worldwide. Within the context of money movement, clearing and settlement are two essential stages. Clearing refers to the verification process that occurs after a transfer is initiated. It involves confirming the availability of sufficient funds in the sender's account. The institution also validates account details on both sides. After clearance, the settlement phase begins. Settlement is when the actual transfer of funds takes place. This includes updating the bank's ledgers to reflect the completed transaction. The central bank's role in this process is significant. In many countries, the central bank provides the infrastructure for clearing and settlement. It facilitates smooth interbank transfers, ensuring liquidity in the banking system. Central banks also set the regulations that oversee these transactions, maintaining financial stability. In some instances, they act as intermediaries, offering settlement accounts to commercial banks. This service simplifies the process of transferring money between various financial institutions. Banks also perform daily reconciliations. This routine involves ensuring that all transactions processed by the bank are correctly recorded. Reconciliation checks are crucial for identifying discrepancies early. Discrepancies could arise due to errors or technical issues during transaction processing. By identifying these promptly, banks maintain their accuracy and reliability. This practice strengthens trust between banks and their customers as it ensures account balances are always correct. In modern systems, electronic funds transfer, or EFT, is a widely used method for moving money. EFT is a digital means of transferring funds from one account to another. This technology eliminates the need for physical cash. Through EFT, transactions can be initiated online or via mobile apps, enhancing accessibility and efficiency. This method is secure, with encryption and authentication techniques safeguarding users' information. EFT has become an integral part of the day-to-day banking experience. Banks often provide customers with access to online banking platforms. These platforms support various money movement activities. Customers can check balances, initiate transfers, and automate bill payments. Such convenience allows individuals and businesses to manage their finances effortlessly. Additionally, online banking reduces the need for in-person visits, streamlining operations for both customers and banks. The rise of digital banking has enhanced the banking system's responsiveness to user needs. To further ensure smooth money movement, banks use a protocol for authorization. Authorization confirms a transaction request is genuine. This involves checking the identity of the person initiating the transaction, usually via passwords or biometric verification. Authorization also includes confirming that enough funds are available in the account to complete the transaction. This protocol is crucial for preventing unauthorized transactions and potential fraud. Transactions involving currencies from different countries are also managed efficiently. Currency conversion is a necessary step in these transactions. Banks calculate the conversion based on the current exchange rate, allowing funds to transfer seamlessly across borders. This service underscores the global connectivity of today's banking systems. Despite differing national currencies, technology and standardized procedures facilitate smooth international transactions. In conclusion, the routine process of moving money through banks is structured and multifaceted. It relies on systems that have been developed and refined over time. From simple deposits to complex interbank transfers, each step is supported by technology and protocols designed for accuracy and security. These processes are embedded within the larger framework of the global financial infrastructure. Everything from individual transactions to international exchanges occurs within this established structure. Money movement within the banking system involves a well-coordinated set of processes. One of the foundational elements is the use of automated clearinghouses. These facilities act as central hubs, coordinating the transfer of money between various financial institutions. Their role is to receive a set of payment instructions from one bank and subsequently pass these on to the recipient financial institution. This ensures that transactions are settled in an orderly and predictable manner. The automated clearinghouse operates at regular intervals throughout the business day, processing large volumes of transactions with efficiency. Each bank utilizes a ledger system to track the money moving in and out of accounts. These ledgers are vital tools, recording every transaction as a debit or a credit. They ensure that each account reflects its true status at any given time. Through these records, banks can maintain accuracy and transparency in their operations. The ledger reflects not just the transactions between banks, but also those within banks themselves. This continuous update of information helps prevent errors, contributing to overall system reliability and trustworthiness. The interbank settlement is another critical part of this movement. This term refers to the process by which banks settle with each other for the net amount of money owed after considering credits and debits. Each bank calculates its net position at the end of a clearing cycle. Afterwards, they settle any balances with their counterparts accordingly. An institution known as the central bank often steps in to facilitate this process, ensuring liquidity and stability. This mechanism helps maintain harmony among the banks within the system. Direct deposit and direct debit are common features of money movement that many people encounter. Direct deposit involves sending funds electronically to a recipient's bank account, eliminating the need for physical checks. Employers frequently use this method for payroll, offering a seamless payment process for employees. On the other hand, direct debit allows service providers to withdraw funds directly from a customer's account as payment for services. These processes rely heavily on the banking infrastructure and underline the routine yet effective nature of electronic transactions. Another component is the role of correspondent banks. These are banks that perform services on behalf of other banks. Often, smaller banks or those operating in different jurisdictions will partner with larger banks to facilitate transactions. Correspondent banks help with transferring money, managing exchanges, and providing credit services. Their participation ensures that even cross-border transactions function smoothly, allowing funds to reach their intended destination without significant delays or complications. Network routing is an integrated aspect of the process, ensuring that every transaction finds its proper path through the banking system. Banks use a mix of established guidelines and advanced technologies to route transactions efficiently. Routing numbers found on checks are one example of identifiers used to direct money to the correct location. These numbers help ensure funds are accurately distributed, preventing misallocation and potential loss. By maintaining stable routing protocols, the system consistently supports financial transactions with confidence. Reconciliation is the step where banks and businesses align their records with each other. This involves matching transactions to ensure consistency between financial statements and bank records. Reconciliation is commonly performed at the end of each business cycle. It becomes a routine method through which discrepancies are identified and corrected. By engaging in such practices, banks can mitigate errors and enhance the precision of financial reporting. This step further strengthens the integrity of the banking system as a whole. The use of bank reserves plays a vital role in supporting money movement. Banks are required to hold a certain percentage of deposits as reserves, typically with the central bank. These reserves ensure that banks have enough liquidity to meet withdrawal demands and other obligations. Reserves act as a buffer, maintaining stability within the system. In times of need, banks may also access additional funds to manage liquidity, ensuring smooth operation and ongoing trust in the banking processes. Electronic transfers, or wire transfers, offer a more immediate form of moving money. Unlike the batch processing of automated clearinghouses, wire transfers are often processed individually and can be completed in short time frames. They are used for more substantial sums or when expedited transactions are essential. This flexibility and speed make wire transfers a favored choice in many instances, though they typically incur higher fees due to their expedited nature and resource demand. Payment systems are the frameworks that enable money movement. These systems are designed to process and authorize transactions within the banking network. They authenticate users, verify account details, and establish links between banks. The continued development and refinement of payment systems allow for ever greater efficiency in processing payments. Emerging technologies in this area focus on enhancing security and reducing transaction times further. The compliance with regulations is a constant consideration for banks as they move money through the system. Regulations help ensure that funds are transferred in a manner that is legal and secure. Compliance departments within banks work to verify that transactions meet all necessary legal requirements. This oversight helps prevent fraudulent activity and supports the system's reliability. Involved processes, such as anti-money laundering checks, underpin the health of the wider economic environment. The systemic risk management approach within banks addresses any destabilizing events that could affect the movement of money. Banks establish frameworks to identify, assess, and mitigate risks associated with their operations. Such strategies involve analyzing both internal and external factors that might influence financial stability. By anticipating potential challenges, banks can adapt and maintain resilience within their processes. This ongoing diligence preserves confidence in the bank's ability to manage through varied circumstances. Thus, the movement of money through the banking system is supported by several layers of routine processes. Each of these facets plays its part in maintaining a steady flow of funds. Money movement within the banking system involves a structured and routine set of processes that are designed to ensure accuracy and stability. At the heart of these processes lies the system of interbank transfers. When a person or business initiates a transaction, the transfer from one bank account to another involves a series of steps that are governed by institutional protocols. These protocols allow banks to communicate securely with one another, ensuring that funds are transferred without error. The transmission of these funds typically begins with the issuing of instructions from the initiating bank. These instructions are precise and standardized, providing clarity to the receiving bank. The role of clearinghouses is central to interbank transfers. A clearinghouse acts as an intermediary, facilitating the verification and reconciliation of transactions between banks. These institutions ensure that the sending and receiving banks conduct the transaction accurately. By managing the process of clearing, these organizations help to reduce the risk of errors. During clearing, the transactional data is checked for consistency and accuracy. This ensures that the amounts being transferred are correctly accounted for, and the corresponding accounts are properly debited or credited. Clearinghouses perform this function using well-established procedures that have been refined over time. Settlement follows the clearing process, marking the completion of the transaction. Settlement involves the final transfer of funds between banks. In this stage, the clearinghouse ensures that the agreed-upon transactions are executed. This involves updating the ledgers of both the sending and receiving banks. Settlement is generally carried out at the end of a defined period, often at the close of a business day. By settling transactions in aggregated batches, the system gains efficiencies while maintaining accuracy. The routine nature of settlement helps banks manage their liquidity needs and ensures that funds are appropriately allocated. Ledgers play a significant role in the day-to-day operations of banks. These records provide a systematic account of all transactions involving deposits and withdrawals. Each entry in a ledger corresponds to a specific transaction, detailing the amounts and accounts involved. Banks maintain both individual account ledgers for customers and a general ledger for the institution as a whole. The precise maintenance of these ledgers ensures transparency and accountability within the banking industry. Routine audits and reconciliations are conducted to verify the accuracy of these records, supporting the integrity of the banking system. Reconciliation is another essential component of the process. This involves comparing records from various systems to ensure consistency. Reconciliation is carried out at regular intervals, often daily or weekly. During this process, banks verify that transactions have been correctly recorded in both their internal systems and in the accounts of corresponding institutions. This helps identify any discrepancies that may arise due to data entry errors or other issues. Corrective actions are then taken as needed, ensuring that all records are aligned. Such practices highlight the importance of accuracy in financial records. The routine nature of these processes is maintained through established regulations and institutional standards. These standards ensure uniformity and reliability across the banking industry. Institutions adhere to national and international regulations that define how transactions should be handled. Regulatory bodies may conduct inspections and audits to ensure compliance. By adhering to these regulations, banks maintain trust with their customers and other financial institutions. The adherence to standards helps ensure that transactions are consistently processed in a reliable and efficient manner. Technology plays an integral role in facilitating money movement within banks. Advanced systems and software applications support the execution and monitoring of transactions. These systems are designed to handle large volumes of transactions with high precision. They automate many of the routine tasks, reducing manual intervention and the possibility of human error. Banks employ encryption and secure protocols to protect transaction data. This technological infrastructure is continuously updated and maintained to meet evolving standards. By leveraging technology, banks enhance their operational efficiency and transaction security. Despite the automation, human oversight remains an important aspect. Bank personnel are responsible for overseeing these systems and ensuring that they function as intended. They monitor for any anomalies or exceptions that may arise during the processing of transactions. In the event of an issue, trained staff are available to intervene and resolve discrepancies. The combination of automation and human expertise ensures a balanced approach to managing money movement. Banking professionals ensure alignment with institutional goals and maintain confidence in the system's reliability. The global nature of banking adds another dimension to the movement of money. International transactions may involve multiple banks and currencies. These transactions require additional coordination and communication between institutions. The SWIFT network is a widely used platform that facilitates international financial transactions. It provides a standardized messaging system that connects banks across the globe. This network allows for secure communication and the exchange of transactional data. The coordination required for international transfers underscores the interconnectedness of the global banking system. Banks also work closely with payment networks to further facilitate transactions. These networks, such as those operated by major credit card companies, enable the movement of money between businesses and consumers. Payment networks provide the infrastructure that allows for the swift processing of transactions at the point of sale. In this network, the bank of the consumer and the bank of the merchant interact to settle transactions. These networks operate on an established framework that ensures financial information is exchanged securely and efficiently. Effective communication between banks and their customers is vital for maintaining banking operations. Customers rely on timely information regarding their transactions and accounts. Banks provide various channels for communication, ensuring accessibility and convenience. Regular statements, online platforms, and mobile applications keep customers informed of their account activity. This communication builds trust and helps customers manage their finances effectively. Banks prioritize customer service, balancing technology with personal interaction when addressing customer inquiries. Central banks have a pivotal oversight function within the banking system. These institutions manage the monetary policy and overall financial stability of a country. Central banks may influence the flow of money through interventions in interest rates or by providing liquidity to financial institutions. They serve as a lender of last resort, offering support during times of financial stress. Central banks also monitor and regulate the activities of commercial banks to ensure adherence to established guidelines. By overseeing monetary policy, central banks contribute to a stable financial environment. The mechanisms underpinning money movement within the banking system are thus varied and structured. Through established protocols, routine processes, and trusted technology, banks manage the flow of funds efficiently. This continuous cycle of transaction processing, reconciliation, and settlement is fundamental to the stability of the financial sector. Once money has been deposited into a bank, it becomes part of a structured and systematic process of accounting and redistribution. Within the banking system, money is not physically stored in separate vaults, but instead recorded in digital ledgers. These ledgers track balances and transactions across accounts. The records are securely maintained and regularly updated. Banks use this information to ensure accuracy and reliability while providing essential financial services to customers. The system relies heavily on electronic processes to manage these movements of money effectively. The banking system uses clearinghouses to facilitate the efficient exchange of funds between institutions. When a check or electronic payment is initiated, the clearinghouse acts as an intermediary. It ensures that the funds are available in the payer's account before crediting the recipient's account. This procedure reduces the risk of errors and provides a clear path for the funds to follow. Routine verification ensures that the movement of money is both safe and precise. By managing this relationship between banks, clearinghouses play a vital role in financial stability. A fundamental component of the banking system is the concept of balance. An account holder's balance represents the amount of money available for use. Each withdrawal or deposit adjusts the balance, which is meticulously tracked to reflect every transaction. The role of balance is crucial. because it determines the available funds in an account at any given time. It ensures that transactions do not exceed the account's funds, maintaining order within the system. Balance tracking is a constant process, integral to the operation of banks and the accessibility of money. Reconciliation serves as a routine procedure that ensures the accuracy of financial records. It involves the regular comparison of ledgers and statements to identify any discrepancies. By consistently verifying that records match, reconciliation helps maintain the integrity of financial systems within banks. This practice supports the trust that account holders place in the security and reliability of their funds. Discrepancies are systematically addressed and resolved through established processes. Reconciliation routines are fundamental to the dependable functioning of the banking industry. Another significant element in the movement of money is settlement. Settlement is the process where transactions are finalized and the transfer of funds is completed. It marks the conclusion of the financial exchange, ensuring that obligations between parties are fulfilled. Settlement can occur in real time or at scheduled intervals, depending on the type of transaction involved. This aspect of banking deals with the precise execution of agreements, allowing both payers and payees to have confidence that their transactions are complete. Understanding settlement provides insight into how money ultimately flows through the banking system. The process of digital transfer involves moving funds electronically from one financial institution to another. Digital transfers are facilitated through secure networks that protect the integrity of the transaction. Each transfer is monitored and recorded, maintaining a comprehensive record of activities. Digital methods speed up the movement of money and enhance accessibility for consumers. By reducing dependence on physical methods, digital transfers offer a convenient way to manage and move funds. Banks utilize these technologies to provide seamless service to their customers. The role of regulatory frameworks within the banking system is worth noting. Various governing bodies establish rules and guidelines to ensure the proper functioning of financial institutions. Regulations are designed to protect consumers, promote fairness, and enhance stability within the system. These frameworks outline the responsibilities of banks and set expectations for their operations. Compliance with regulations is a continuous process that banks adhere to as part of their normal activities. Adherence to regulations forms a backdrop to how money moves through the financial landscape. Understanding interest rates is important in the context of the banking system. Interest rates represent the cost of borrowing or the reward for saving money within a bank. They influence decisions related to loans, deposits, and investments. Changes in interest rates can have a ripple effect throughout the economy, impacting various aspects of financial operations. Banks manage interest rates based on economic conditions and policy directives. The interplay of interest rates within banking contributes to the ongoing circulation of money. The concept of credit within banks facilitates the flow of money through the granting of loans. When a bank provides a loan, it creates an obligation for repayment with interest over time. This process enables consumers and businesses to access funds beyond their immediate means. Credit expands economic opportunities and supports growth by allowing deferred payments. The bank records these transactions meticulously, incorporating them into its broader management of funds. The availability and terms of credit are factors that influence financial mobility. The custodial role of banks extends to the safekeeping of assets beyond cash. Individuals and institutions entrust banks with securities, valuables, and other financial instruments. Banks manage these on behalf of their clients, ensuring safety and proper handling. The secure custody of assets is an evolving aspect of banking practices. It includes the management of both tangible and intangible assets through well-defined custodial services. This responsibility underscores the trust placed in banks by customers seeking protective management of their financial interests. Interbank lending is another mechanism that supports the smooth movement of money. Banks often lend to each other to address short-term liquidity needs. This lending occurs in the interbank market, where banks negotiate terms and interest rates for these temporary loans. Such interactions help maintain balance in the system, ensuring that banks can fulfill their obligations. The practice is common and routine, forming part of the broader financial ecosystem. Interbank lending reflects the interconnected nature of financial institutions within the larger network. The role of banks in facilitating foreign exchange is a component of their broader functions. Banks help exchange different currencies for their clients, managing conversions smoothly and efficiently. This process supports international trade and travel, allowing businesses and individuals to operate across borders. Currency exchange involves carefully monitored rates that fluctuate based on market conditions. This service is crucial for global economic interactions and contributes to the versatility of banking operations. Foreign exchange remains a routine, familiar activity within many banks. Lastly, technological integration continues to transform how money moves through banks. The adoption of new technologies has brought enhancements to security, efficiency, and customer convenience. From mobile banking applications to advanced data analytics, technology reshapes traditional processes. These innovations provide banks with tools to streamline operations and improve user experiences. The steady incorporation of technology reflects an ongoing evolution in banking practices. This integration demonstrates the adaptability and forward-looking perspective of financial institutions. The process and principles outlined here characterize how money moves within the banking framework.